Listen, if you're holding physical silver right now, what I'm about to share could be the difference between watching your wealth multiply or missing the biggest opportunity in precious metals since 1980. And I'm not talking about some distant future event. The setup happening right now is so precise, so mechanical, that the people who understand what's coming are quietly repositioning before the crowd figures it out. Let me show you exactly what's happening behind the scenes. Because the mainstream financial media isn't going to tell you this story. They can't. It would expose too much about how the system actually works. Right now, there's a structural imbalance in the silver market that's never existed before in modern history. And I mean never. We're talking about a supply deficit that's been building for 3 consecutive years, while industrial demand is accelerating at a pace that's catching even the mining companies off guard. The Silver Institute just released data showing a 142 million ounce deficit in 2024. That's physical silver that was consumed but doesn't exist to replace it. And 2025 is projected to be worse. But here's where it gets interesting. That deficit number, it's actually conservative, because it doesn't account for what's happening in the solar panel industry right now. China is building solar capacity at a rate that's doubled every projection from just 2 years ago. Each panel requires silver. Not a little bit. We're talking about 20 grams per panel on average, and they're manufacturing panels at a scale that's consuming roughly 200 million ounces annually just for solar. That number was 140 million ounces in 2022. Now, you might be thinking, okay, supply deficit, increased demand, that should push prices up. And you'd be right. Except there's a mechanism in place that's been suppressing that natural price discovery. And that mechanism is starting to break. The COMEX silver market trades about 200 million ounces of paper silver contracts every single day. Physical silver production globally? About 2.5 million ounces per day. You see the problem? The paper market is 80 times larger than the physical market. It's been this way for decades, and it's allowed large institutions to control the price through futures contracts that never result in physical delivery. Only about 1% of COMEX contracts actually settle in metal. The rest are cash settled or rolled forward. But something changed in late 2024. The delivery requests started increasing, not dramatically at first, just enough to notice if you were watching the warehouse stock reports. COMEX registered silver, that's the metal available for delivery, dropped from 78 million ounces in January 2024 to 41 million ounces by December. That's a 47% decline in deliverable inventory while open interest in futures contracts remained elevated. And then in January 2025, something unprecedented happened. A series of large delivery requests hit the exchange simultaneously. We're talking about demands for 15 million ounces in a single week, the kind of size that makes traders nervous because it tests whether the metal actually exists behind the paper contracts. The COMEX scrambled, moved metal between warehouses, and managed to fulfill the deliveries. But the registered inventory dropped to 38 million ounces. Now here's what most people don't understand about how this system works. When registered inventory gets below a certain threshold, the mechanics of the market change. It's like a game of musical chairs where suddenly everyone realizes there aren't enough chairs. The commercial banks that typically short silver futures to hedge their positions start getting nervous. Their risk management models start flashing warnings. Because if they can't deliver metal against their short positions, they face unlimited losses as the price spikes to wherever it needs to go to find physical supply. We saw this exact scenario play out in nickel in March 2022. The London Metal Exchange had to halt trading and cancel trades when a short squeeze pushed prices up 250% in 2 days because there wasn't enough physical nickel to deliver against contracts. The entire market structure broke. They literally had to rewrite the rules to prevent a complete collapse. Silver is setting up for the same type of event, except the implications are far larger because silver is held by millions of individual investors, not just industrial users. And unlike nickel, silver has monetary properties. It's been money for 5,000 years. When people lose faith in paper currencies, they don't buy nickel, they buy gold and silver. Let me give you some context on where we are in the bigger picture. In 1980, silver hit $50 an ounce during a period of high inflation and currency instability. The Hunt brothers famously tried to corner the market, but even without their involvement, silver was responding to the same forces we're seeing today. Loss of confidence in the dollar, inflation running hot, and a supply squeeze. When the price peaked at $50, that was equivalent to about $185 in today's inflation-adjusted dollars. Right now, silver is trading around $32 an ounce. That means even if silver just returned to its 1980 inflation-adjusted high, we're looking at a potential 5x move from current levels. But here's the thing. The fundamentals today are actually stronger than they were in 1980. Back then, silver was primarily a monetary metal and had some industrial uses in photography. Today, silver is absolutely critical for the green energy transition, electric vehicles, 5G infrastructure, and advanced electronics. The industrial demand floor is far higher than it was 45 years ago, and the supply situation is worse. In 1980, there were large above-ground stockpiles of silver from decades of mining. Today, those stockpiles are gone. They've been consumed by industry. The Silver Institute estimates there are only about 2.5 billion ounces of above-ground investment silver in the world. That sounds like a lot until you realize that's only about $80 billion worth at current prices. Apple's market cap is $3.5 trillion. The entire global investment silver market is smaller than 2.5% of one company's valuation. What happens when institutional money decides to allocate even a small percentage to physical silver? The math doesn't work. There isn't enough metal to absorb that demand without a massive price spike. And we're starting to see the early signs of that institutional interest. In November 2024, a major hedge fund filed a 13F showing a new position in physical silver bullion worth $340 million. That's not silver mining stocks, that's actual metal. When a fund that size takes physical delivery, it removes that metal from the available supply permanently. They're not trading it. They're storing it as a long-term inflation hedge. Then in December, news leaked that a sovereign wealth fund in the Middle East had been accumulating silver through private dealers, bypassing the COMEX entirely. The estimated size of their position? Somewhere north of 50 million ounces. That's more than the entire registered COMEX inventory. And they're not selling. They're holding it as a strategic reserve alongside their gold. This is the smart money positioning before the price spike. They understand something that most retail investors don't. When a commodity is in structural deficit and the paper market that controls price discovery starts breaking down, the price doesn't move in a straight line. It gaps. It jumps overnight. You wake up one morning and silver is up $8 because a major short position got liquidated or a delivery default triggered a cascade of buying. We saw a preview of this in March 2020 when COVID hit. The physical silver market completely disconnected from the paper price. COMEX silver was trading at $12 an ounce, but you couldn't buy a physical silver coin for less than $20. Dealers were sold out. Premiums exploded to 60 to 70% over spot price. The paper market said silver was cheap, but the physical market said there was no metal available at that price. That disconnect lasted for months, and it revealed the truth about the silver market. The paper price is artificial. It's a function of leverage and derivatives, not actual supply and demand for physical metal. When stress hits the system, the physical market takes over, and the real price emerges. Now, if you're holding physical silver, you need to understand what's likely to happen in the next phase of this setup, because there's a specific sequence of events that typically unfolds during a precious metal squeeze, and we're seeing the early stages right now. First, you get the supply deficit that builds quietly while most people aren't paying attention. That's been happening for 3 years. Check. Second, you get increased delivery requests on the futures exchanges as sophisticated players start testing the system. That started in late 2024. Check. Third, you get a decline in registered inventory that accelerates as more metal gets withdrawn. We're in this phase right now. COMEX registered silver is at multi-year lows, and the trend is accelerating. Fourth, you get a breakdown in the basis, which is the relationship between the futures price and the physical price. When the basis blows out, it means physical metal is commanding a significant premium over paper contracts. We're starting to see this. Physical silver premiums have been elevated for months, and they're not coming down despite higher prices. Fifth, you get a short squeeze as the commercial banks that are short futures contracts start covering their positions because they can't risk a delivery default. This is the phase where price moves get violent. We haven't hit this yet, but the setup is there. And sixth, you get a rush of retail and institutional buying as the price momentum attracts attention and FOMO kicks in. This is the blow-off top phase where silver makes its biggest gains in the shortest time. We're somewhere between phase 3 and 4 right now. The smart money is positioning before phase 5 because once the short squeeze starts, you won't be able to buy physical silver at anywhere near current prices. Dealers will be sold out, premiums will explode, and you'll be competing with institutions that have far deeper pockets. So what should you do if you own physical silver right now? This is critical. Don't sell. I know that sounds obvious, but you'd be surprised how many people get shaken out right before the big move. They see silver pull back $2 or $3 and they panic thinking they missed the top. But in a structural bull market driven by supply deficits and monetary instability, the pullbacks are buying opportunities, not selling signals. What you want to do is make sure your silver is in your possession or in a secure, allocated storage facility where you have direct ownership, not a bank safety deposit box, not an unallocated pool account, not a silver ETF where you own shares but not metal. You want physical silver that you can hold, or that's stored in your name with clear title. Because here's what happens during a crisis. When the system gets stressed, counterparty risk becomes real. If your silver is held in an unallocated account, you're an unsecured creditor. If that institution fails, you're in line with everyone else hoping to get paid. If your silver is in a bank safety deposit box, you're subject to whatever restrictions the bank imposes during a crisis. We saw this in Greece in 2015. Banks limited access to safety deposit boxes during the capital controls. But if your silver is in your direct possession or in an allocated vault where you have specific bars or coins assigned to you, you have no counterparty risk. That metal is yours regardless of what happens to the financial system. Now, there's another consideration here that's relevant for a lot of people watching this. If you have significant retirement savings in traditional accounts, IRAs or 401ks, you might want to look at how precious metals fit into that picture. Because one of the challenges with physical silver is that you can't hold it in a standard retirement account. The IRS has specific rules about what qualifies. But there is a structure that allows you to hold physical precious metals in a tax-advantaged retirement account. It's called a gold IRA, and it works with silver too, despite the name. Basically, you set up a self-directed IRA with a custodian that specializes in precious metals, and you can purchase physical gold, silver, platinum, or palladium that's stored in an IRS-approved depository. You get the tax benefits of the IRA structure while holding physical metal instead of paper assets. I put together a free guide that explains exactly how this works, what the rules are, and how to set it up without triggering taxes or penalties. It's in the description below. If you've got $100,000 or more in retirement accounts and you're concerned about the dollar's purchasing power over the next decade, it's worth understanding how this structure works. No obligation, just information so you can make an informed decision about whether it makes sense for your situation. All right, back to what's happening in the silver market right now, because there's another layer to this that most people aren't aware of. The central banks. Everyone knows central banks have been buying gold at record levels. In 2022 and 2023, central banks purchased over 1,000 tons of gold each year, the highest levels in decades. They're diversifying away from dollar reserves and building their gold holdings as a hedge against currency instability. This is well documented. What's not well documented is that some central banks are also accumulating silver, not through official channels that get reported to the IMF, through private dealers and off-market transactions that don't show up in the data. Why? Because silver is far more volatile than gold, and central banks don't want to move the market or signal their intentions. But if you talk to people in the wholesale physical market, the large dealers who move metal in 1,000-ounce bar form, they'll tell you there's been persistent buying from entities that have the characteristics of sovereign buyers. Large orders, specific delivery requirements, long-term storage arrangements, and no price sensitivity. They're not trying to time the market. They're accumulating a strategic position. This makes sense when you think about it. If you're a central bank in a country that's trying to reduce dollar dependence, you want hard assets that have monetary properties and can't be devalued by another country's monetary policy. Gold is the obvious choice, but it's expensive and the market is large enough that your buying gets noticed. Silver gives you similar properties at a much lower entry point, and the market is small enough that a relatively modest allocation can secure a significant position. If even a handful of central banks are doing this quietly, it explains some of the persistent physical demand we've been seeing that doesn't match up with the visible ETF flows or reported industrial consumption. There's a buyer in the market that's absorbing supply consistently, and they're not selling. And this brings us to the geopolitical dimension of what's happening, because silver, like gold, is becoming a tool in the broader de-dollarization trend that's accelerating globally. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus the expanding list of countries joining or applying to join, are actively working on alternatives to the dollar-based financial system. They're settling trade in local currencies, building payment systems that bypass SWIFT, and accumulating gold reserves to back potential new currency arrangements. Silver fits into this picture because it's a monetary metal that's far more accessible than gold for smaller transactions and broader public participation. If you're trying to build confidence in a new currency system, Having it backed by or convertible to precious metals makes it more credible than a purely fiat system, and silver, with its lower price point, allows for practical circulation in a way that gold doesn't. China understands this better than anyone. They've been accumulating gold reserves for years, but they've also been the world's largest silver producer, and they've been importing silver aggressively. In 2023, China imported over 200 million ounces of silver, a significant increase from previous years. They're not exporting it. It's staying in the country, going into industrial use, yes, but also into private hands and potentially strategic reserves. If China ever decides to back the yuan with a basket of commodities, including precious metals, the global silver market would be completely upended, because they'd need to secure enough silver to make the backing credible, and there simply isn't enough available supply to meet that demand without a massive price increase. This is the kind of scenario that keeps silver analysts up at night, not because it's likely to happen tomorrow, but because if it happens at all, the price adjustment would be so violent that you wouldn't have time to react. You'd wake up one morning and silver would be trading at $60 or $80 or $100, and the physical market would be completely locked up with no metal available at any price. Now let's talk about the mining side of this equation, because that's where the supply deficit becomes really concerning. Silver mining is not like gold mining. About 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Only about 30% comes from primary silver mines. This means silver supply is not very responsive to silver prices. If silver doubles, it doesn't necessarily incentivize more silver mining because the economics of the operation are driven by the primary metal. And right now, the primary metals that produce silver as a byproduct are facing their own challenges. Copper mines are dealing with declining ore grades, meaning they have to process more rock to get the same amount of copper. This is happening globally. The average copper ore grade has declined by about 30% over the past 15 years. When ore grades decline, byproduct silver production declines too. On top of that, there's been significant underinvestment in new mining projects over the past decade. After the 2011 peak when silver hit $49, prices declined for years and mining companies cut exploration budgets. The projects that would be coming online now to increase supply were never developed because the funding wasn't there during the low price years. This creates a lag effect. Even if silver prices spike today, it takes 7 to 10 years to bring a new mine from discovery to production. The supply deficit we're experiencing now can't be fixed quickly. The only way to balance the market in the short term is through price. Price has to rise high enough to either stimulate recycling, reduce industrial demand, or pull metal out of existing above-ground stocks. But here's the problem with that. Industrial demand for silver is relatively inelastic. If you're manufacturing solar panels or electric vehicles, you can't just stop using silver because the price went up 50%. It's a critical component. You either pay the higher price or you shut down production. Most companies will pay the higher price and pass the cost on to consumers. And recycling, while it does increase with higher prices, can't make up the deficit. Silver recycling currently provides about 180 million ounces per year, mostly from industrial scrap and old jewelry. Even if that doubled, which would be unprecedented, it wouldn't close a 150 million ounce annual deficit. So the adjustment has to come through price, and the price has to rise enough to either bring forward new supply that's currently uneconomic or reduce investment demand significantly. But if investment demand is being driven by concerns about currency debasement and inflation, higher prices might actually increase investment demand rather than reduce it. People buy silver because they think it's going higher, not because they think it's cheap. This is the setup for a reflexive feedback loop. Higher prices attract more buyers, which pushes prices higher, which attracts more buyers. It's the classic momentum trade, except it's backed by real physical supply constraints, not just speculation. We saw this in 2011 when silver went from $18 to $49 in less than a year. The move was driven by a combination of QE2 monetary stimulus, concerns about sovereign debt in Europe, and a short squeeze on the COMEX. When silver broke above $30, it triggered stop losses and momentum buying that pushed it to $49 in a matter of weeks. The move was so fast that it overshot fundamentals and eventually corrected. But even after the correction, silver never went back to the pre-2010 levels. It established a higher base. We're potentially setting up for a similar move now, except the fundamental backdrop is stronger. The supply deficit is real and structural, not temporary. The monetary environment is more unstable with higher debt levels and persistent inflation. And the geopolitical tensions are more severe with the de-dollarization trend and the fragmentation of the global financial system. If silver breaks above $35 and holds, the technical picture suggests a move to $45 to $50 is likely. That's where the 2011 highs are, and that's a major psychological level. If it breaks through $50, there's no technical resistance until you get to the inflation-adjusted 1980 high around $150. Now, I'm not saying silver is going to $150 next month, but I am saying the path is clear if the fundamental drivers continue to play out. And those drivers are accelerating, not slowing down. The U.S. government is running trillion-dollar deficits with no plan to reduce them. The Fed is trapped between fighting inflation and supporting the economy. If they keep rates high, they risk a recession and a debt crisis. If they cut rates and restart QE, they risk reigniting inflation and destroying confidence in the dollar. Either scenario is bullish for precious metals. Meanwhile, the rest of the world is watching and making decisions about how to protect their wealth. The dollar's share of global reserves has been declining steadily. It's now below 60%, down from over 70% 2 decades ago. That trend is accelerating. Every percentage point that shifts out of dollars has to go somewhere. Some goes into euros, some into yen, some into yuan. But increasingly, it's going into gold and silver. This is the macro backdrop that's driving the structural bull market in precious metals. It's not about short-term trading or technical patterns. It's about a fundamental shift in how the global monetary system operates and how wealth is preserved during periods of currency instability. If you own physical silver right now, you're positioned for this shift. You're holding an asset that has 5,000 years of history as money. That's in structural supply deficit. That's critical for the green energy transition. And that's being accumulated by smart money before the crowd figures out what's happening. What you don't want to do is get shaken out by short-term volatility or sell because you need to pay bills. Physical silver is a long-term strategic holding. It's insurance against monetary instability and a speculation on the supply deficit resolving through higher prices. You hold it through the volatility because the end game is a significantly higher price level that reflects the true scarcity of physical metal. And you make sure it's stored securely where you have direct access and no counterparty risk. Because when the system gets stressed, and it will get stressed, the difference between owning physical metal and owning a claim on metal becomes very real very fast. The people who understand this are positioning now, before the price spike, before the physical market locks up, before the premiums explode. They're not waiting for confirmation or for the mainstream media to tell them it's safe to buy. They're acting on the data, the fundamentals, and the structural setup that's visible if you know where to look. The silver market is sending clear signals right now. Declining COMEX inventory, persistent physical premiums, increasing delivery requests, and a supply deficit that's getting worse, not better. These are not subtle hints. These are flashing red lights that the current price level is not sustainable and that a major adjustment is coming. The question is not whether silver is going higher. The question is whether you're positioned before it happens or whether you'll be chasing it after the move has already started. Because once this thing breaks, once the short squeeze triggers, or a delivery default happens, or a major institution announces a large physical position, the game changes instantly. The metal disappears from the market, premiums go vertical, and you're competing with people who have far more resources and urgency than you do. That's the reality of what's coming. The setup is there. The fundamentals support it. The technical picture confirms it. And the smart money is already positioned. The only question is whether you're going to act on this information or whether you're going to watch it happen and wish you had. If you own physical silver, hold it tight. Make sure it's secure. And understand that what you're holding is likely to be worth significantly more in the not-too-distant future. Not because of hype or speculation, but because of basic supply and demand in a market that's been manipulated for decades and is finally breaking free. This is the opportunity. This is the moment. And this is what you need to do before the price spike happens and the window closes.